Once you close the first one, think of it like a video game. You're leveling up. So once you get that first one in, now all of a sudden you become attractive and people want to deal with you because they think you're legit.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. I'm so glad you're here with us today. Thanks again for being a part of our show, of course. And for our faithful listeners and followers, please do give us a like, a review, on whichever platform you use for podcasting purposes. It definitely helps us to push the message out to more people. Of course, I've got another amazing guest with me today. I've got Charles Seaman. Charles, welcome to the show.
Jeremy, thanks for having me. It's a pleasure to be here this morning.
Likewise, and look forward to spending some time with you here. Just to give my listening audience a little bit of a background on Charles. So he's currently a general partner in 5 multifamily properties totaling 663 units. He's gone full cycle on 6 multifamily properties, which is exciting. And he also is a multifamily coach with Master Passive Income. Charles, I'm not doing your background, very much due diligence here. So we'd certainly, like to hear a little bit more about, you, your journey, what you're focused on, today, et cetera.
Absolutely. Well, I'm glad to share about that. So my approach probably started a little bit different than many because when I first got into commercial real estate, it wasn't so much that I was actively seeking to be an investor at that time. The way I describe it, jokingly, as I say, I was young, dumb, and broke, and I needed a job. And I was 20 years old, and I was at a point where I was trying to figure out what am I doing with my life, and I wound up getting a job with a very successful business owner and commercial real estate investor in New York. And that opportunity really gave me exposure to a lot of different industries, a lot of different connections. And of the different industries that I was exposed to there, commercial real estate was always the one that really piqued my interest. And it was the one that I knew sooner than later that I'd like to follow that path. So when I first started that position, my intent was to stay there for 2 to 3 years, get on my feet financially, and then eventually leave and do my own thing. And sometimes as life happens, things don't always go as planned. I started gaining some more responsibility there, started making some more money, maybe thinking I was important. And, I wound up staying there 14 years. And as I got into my early 30s, I started really doing some soul searching and saying, when I first started here, my intention was to be here for a couple of years, kind of get a good solid financial foundation, and then go out and do my own thing. And somewhere along the way that changed. I guess I got into a spot where I was making better money, and maybe I just got comfortable with it. And I thought to myself, well, what am I doing? Do I still want to go out and do my own thing? Am I happy staying here? And at the end of the day, I would never have been rich working there, but I wouldn't have been poor. There would have been consistent work and consistent money, which is good. But part of me deep down inside always knew that, I had an entrepreneurial spirit, and that's what I wanted to focus on. So after, diving into single family for a little bit, not having a lot of success with it because I realized that, one, I just didn't like it as much, and two, I wasn't good at it. I kind of felt deflated because I was like, boy, I'm working on these big deals here at work, and now I go home and I'm looking at a single family home, and I'm like, it didn't excite me. So took a step back, fast forward to like 2016. That was the first time I discovered syndication, or at least in connection with like multifamily. And starting to dive into it, I wound up taking a couple of courses. And after about a few months, mid 2017, I started actively looking for deals. And for the first year and a half, 2 years, I was doing it part-time while still working my full-time job. Probably 10 to 15 hours a week between looking at deals, phone calls, meetings. And in my prior job, I never really took a lunch break. I'm sure I could have legally, but it wasn't really something that we encouraged. So as I started getting into multifamily, I took a lunch break because I had to use that time to go out and make calls. And I would call, brokers, investors, lawyers, whoever it might be that I needed to speak with at that day, at that time. So after about 2 years, I realized, well, I had made some progress. It wasn't really the progress I had hoped for. And I thought to myself and said, well, I can keep doing this part time, and it'll probably take me 10 years to get a deal. Or I can just give it the old college try, leave my job of 14 years, move to a different city, and see what happens. So, being the entrepreneur that I am, I decided that it was going to be option two. And I said, let's just make it adventurous. We're going to get a totally fresh start in a totally different area. So the reason I moved to Charlotte, my partners and I at the time decided that Charlotte and really the Carolinas as a whole would be our target market. So I always thought, how do you know the market better than living and working in it every single day? And my thought was, let me put myself in the center of it. That's going to give me a chance to build better connections, to get to know the market and the people better, and to be able to ultimately find deals faster. So that's what I did. In June 2019 on, I went full time in it. So that kind of brings us to where we are now. And shortly after that, I closed my first deal. And once you close the first one, all the future deals definitely come a lot easier. I always say it's kind of like, think of it like a video game. You're leveling up. So once you get that first one in, now all of a sudden you become attractive and people want to deal with you because they think you're legit. And it gives you some credibility. And every deal you close, it gives you access to maybe a bigger, better deal that you wouldn't have had access to previously.
Yeah, absolutely. And I'd love to unpack, what you just said there in a little bit here in terms of how you work with the broker community and how you really, have increased your stock price, so to speak, in the syndication space. But I really, love your background and your background, by the way, is very similar to so many busy professionals, working in corporate America, where we kind of, come out of college or high school, young, dumb, and broke. And by the time we get into our 30s, or maybe in some cases, people in their 40s, they really start to soul search and look for ways to get off the corporate hamster wheel, at some point. And oftentimes that manifests itself in people really scratching that entrepreneurial itch. And it sounds to me like you just decided to maybe not rip that Band-Aid off entirely from corporate America, but you spent, a couple of years, really kind of balancing both things at the same time. You had your primary hustle, your main hustle, your corporate job, while at the same time, you were able to scratch that entrepreneurial itch, learn more about real estate, start to network and build those connections and those relationships. So really appreciate, you breaking that down. And I obviously have to say, you also, found your way into real estate by initially starting, in the single family space, which for me was the exact same thing. That was really the gateway drug that led me, into multifamily. So appreciate that you breaking that down.
Yeah, absolutely. I think that's a common path that many people take. It's like they want to see the progression. Admittedly, what kind of drew me to that, I knew more about commercial real estate from what I was doing at my full-time job, but I also knew that I didn't have the money to go out and buy commercial real estate on my own. And that's what kind of attracted me to single family. And I said, okay, let me start looking at this because this is a little more within my price range. And then after that, when I took a step back, I discovered syndication. I said, okay, this could be a good fit.
Yeah, that's great. Let's talk a little bit about the broker relationships that you have, because I know that relationship between sponsor, syndicator, and local brokers in that market is paramount. So I know that building those relationships is key to your kind of journey. What strategies do you use to cultivate and maintain strong relationships with the broker community?
Great question. So I always say the approach I take is probably a very old-fashioned one, which is why I moved to the market that I focus in, and it's very much getting in front of people. Lunch, drinks. I say this jokingly, but also with a lot of truth. Probably 90% of the properties I tour, properties I have no interest in, but I do it just to get in front of the brokerage community and stay relevant. And a lot of times when they see you on site, or they see you, whatever it is, happy hour, coffee, a lunch meeting, you start to become more real and more legit to them. And it just builds and strengthens that relationship. So my good broker relationships, I like to get in front of them in person at least every 2 to 3 months, because I find by doing that, it keeps you relevant. A lot of times when I'm at a lunch meeting or a coffee meeting, probably 90% of the conversation is non-business related. And the sooner that you can shift the conversation away from business and to other things, the better and the stronger the relationship gets. So, and then when it shifts back to business, what usually happens is at the end of each of these meetings, most of these guys start thinking, what do I have that I can give this guy? And they'll say, would you be interested in this? And almost always my answer is yes. Because, I don't know if I'm interested in it until I look at it. So send it over and let's take a peek. But from a high level, they'll give me some details. And, most of my deals have actually been worked out over lunch meetings or drinks. And a lot of the deals have been kind of discussed, at least from a high level. And then you go back and you check them out and put them on paper and write everything up.
Yeah, makes total sense. And for those that maybe non-savvy investors that don't understand, a lot about real estate syndication, it's very much a very heavy relationship business, right? It's that adage, out of sight, out of mind. And
Yes.
really, it takes a lot of really nurture of that relationship. And oftentimes there are deals that never even hit the public markets. And those are what we call obviously off-market deals. And so it's really through that strong connection or that strong relationship that exists between the sponsor and the broker that can really be paramount to getting a deal under contract and even getting a deal at a good basis. So really appreciate you breaking that down. I would like to talk and pivot to the topic of underwriting. I know that you've got some extensive experience in underwriting. So for that, new investor, that maybe not sophisticated investor, non-savvy investor, what are maybe, 2 or 3 different, key metrics or factors that you prioritize when underwriting multifamily properties?
Great question. So for me, there's really 3 that I focus on in the syndication space. The first is your cash on cash return, and that's going to be a measure of how strong the cash flow is based on the capital you're putting into it. The average annual return, which basically takes your return throughout the life of the investment and divides it by the number of years you expect to be in it, and your IRR, which is, for lack of a better term, the risk adjusted return that you're going to see. So those are the 3 I really focus on. A 4th one I would give, while not necessarily a return metric, I would refer to it more as a safety trigger, is your debt service coverage ratio. And I would never get into a deal because of a good debt service coverage ratio, but I would certainly stay out of deals if it isn't good.
Yeah, that makes total sense. And those are great metrics, I think, to look at from an underwriting perspective. I might add, one more to the mix here. And that is, if the strategy is to acquire a property that was built 20, 30, 40, 50 years ago, as an example, and it's a value add play, at the end of the day, a couple of really important metrics to dial into obviously are, what does that rent growth projection look like? And at the end of the day, if you push the rents to achieve the NOI growth that you're looking for, can the residents that live there today or the tenants in that local market, can they actually afford the increase in rents? If they can't, then that's a big red flag to me. So really appreciate you breaking that down for us. I know that you've gone full cycle on a half a dozen deals. Can you share a particularly challenging deal maybe and some lessons that you learned because of it?
Yeah, absolutely. So of those 6, 5 of them have had favorable results, 1 not so favorable. So I'll talk about that one because that, I guess, by default would have to be the most challenging one. So that one was one that we purchased at the beginning of March 2022. So for anybody who's new to the market, there was a lot of things happening at that time. Market conditions were starting to change. Interest rates were starting to come up. There was talk that the Fed was going to hike rates 7 times that year. None of us really knew exactly where it would go. And lo and behold, that wound up happening. So for those of us who had deals with floating rate loans, myself included with that one, it became very challenging because with any property you had, most times when you're stress testing something, you're stress testing it with the assumption that that's kind of a worst case scenario. You're not really planning to run the property there the entire duration of the hold period. So that made it more challenging. So between rising interest rates with the floating rate loan, insurance premiums coming in, substantially higher in the future years than you expected because the insurance market itself had changed, and just market conditions softening because this was a C-class value add property. So one of the things you touched on, Jeremy, was very important, and I don't think it gets enough talk in our industry oftentimes, and that's with really knowing the income demographics of the submarket you're in. So while we knew the income demographics, what we probably didn't properly account for is how much it might impact their ability to pay the rents. And we were successful at pushing rents, we were successful at leasing, but we consistently had collection troubles. And I find that to be the case right now with pretty much every C-class property that I'm personally in, and even ones that I know other operators and that I speak with. And I think that's a major thing because market conditions have changed. So one thing that's happened in the last few years is we hit a point in many markets where rent growth has flattened and in some cases even declined, where expenses haven't. Expenses are still went up. So that means you're using the same income you had starting out, but your expenses are increasing and now you have less cash flow. And then if you have a floating rate loan with a rising interest rate, it's a perfect recipe for disaster. So that's basically what happened now. And we did wind up exiting that property. Thankfully, it was just a small loss for the investors, but obviously that's not the goal when you go in. We were happy that we were able to preserve most of the principal, but the goal is to make people money, not to lose money. So
yeah, and really honestly, Charles, I really appreciate your transparency in that as well, because being in this industry for the time that I have been and having networked with multiple sponsors and multiple different asset classes, different geographies, and have invested with a lot of them as well, I can tell you that the picture in the last 3 to 4 years has not been incredibly rosy.
yeah,
There's a lot of distress in the market. There are operators out there that have lost investor capital, have suspended distributions, have had to perform, capital calls on their deals. And, everybody wants to know what the track record is. So I'm going to be curious to know how sponsors present, that track record, as we go forward, especially as it relates to deals that maybe they acquired in 2021 and 2022 when everybody was running into the fire. And the reality is they probably should have been running out of the fire.
yeah, you're absolutely right.
I'm Zach Happenstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, you can go to our website and set up a call with our team.
So why is it that you have made the decision to focus on that kind of C-class asset, demographic, as opposed to maybe a B class, A class, core plus, et cetera?
Great question. So it's funny you asked that because I'm actually in the process of changing that for the future. But a large part of the reason that I focused on that starting out was two reasons. One, the returns are generally a little more attractive with the C-class property. Now, keep in mind, with anything, you're not getting a better return because there's less risk. So keep that in mind. You're getting a better return because there's more risk, right? So if you go out and buy an A-class property, it's generally referred to as a coupon flipper. You're not getting maybe the best return, but it's consistent. So C-class, especially if it's a value add opportunity where you're going in there and doing some type of operational play or physical improvement, there's inherently more risk because you're basically moving out some portion of the tenant base and replacing them with a new portion. So you're taking the risk that you're going to get better qualified tenants. You're taking the risk that you're going to be able to actually hit the rent targets you projected. So, there's better return profiles. The second thing I would say is, transparently, a lot of times those deals are easier to win when you're starting out. When you're more established, you have more options. Like earlier on in the conversation when I was saying how you kind of level up, one of those things you typically level up in is the quality of the asset class that you have access to. When you're first starting out, you're probably not going to have as much of an opportunity to win an A or a B property because, brokers and sellers want to see stronger groups with established track records many times for those properties. Sometimes you will, never say never, but it's going to be tougher. Whereas C-class generally tends to attract a newer buyer pool, and because of that, it does make it easier to win. Going forward, though, I do intend to shift to a better quality property for sure.
Yeah, makes total sense, and I appreciate you sharing that. I would think that another component to starting off in the C class space is usually you can transact those deals at a lower price point, which also means a lower equity raise. So speaking about equity raise, we regularly have fund managers and capital raisers, capital partners, that listen to our podcast, and I know that capital raising is a critical aspect of closing deals. So what advice would you give to somebody, looking to improve their ability to attract new investors?
Well, in terms of attracting new investors, what I would tell anybody is it's a relationship business, and relationships take time to build. So what that means is if somebody's going out and you get that first deal, that isn't the time to meet somebody for the first time and say, do you want to invest in my deal? Now, if you're doing a 506C, while that could be legally allowable, at least in my own experience, I've never found it to be very successful because most times when people are investing 50 or 100 or $200,000 with you, they want to at least have some idea who you are. You're not just cold calling somebody and asking them to invest, $5 in a widget with you. I mean, you're asking for a sizable amount. So start building those relationships as early as you can, ideally before you even have a deal. And like the common challenge people have when they're starting out is, well, what do I present to them? Well, there's a few things you can do. One, you can use a mock deal, which is something many people do, and kind of say this is a deal I'm looking at and what it would look like. Uh, or you can just tell them transparently kind of what the buy box is and what the expectation is, so you set the parameters. But the more important part is the communication and staying in touch. Because the more touch points you get, the more comfortable people feel with you, and the more likely they are to actually part ways with money and give it to you.
Yeah, totally agree with that. It's very difficult, I would say, in the capital raising space to really systematize, the effort. Certainly there's, best practices, but at the end of the day, it's a relationship business, and it all comes down to, that capital partner, capital raiser, fund manager, sponsor, if they're raising capital for their own deal. It really comes down to their own individual brand equity, right? And we literally enhance our brand equity one drop at a time, and we lose it in a bucketful if we make mistakes, right? So really appreciate you highlighting the importance of just making connections, nurturing relationships, and really staying genuine. What just out of curiosity, as far as asset management is concerned, what systems or processes do you use to effectively manage assets after acquisition to really maximize and enhance returns for your investors?
Yeah, great question. So, you know, with the property management companies we're working with, we're currently working with third party in most instances. So they usually have a property management software based on, whatever they're using for their entire portfolio. So that varies a little bit from company to company. But it's a few things. One is we always get access to the property management software and to the bank accounts. We want to check those things regularly just to make sure that everything lines up. We do a weekly meeting with each of our property management companies, because one of the things that I find that's really key for success is regular communication. And I think that starts from the time you buy the asset all the way up until the end. So the first thing I like to do, well, even before closing, let's go back to that. So before closing, when I'm first looking at a deal and underwriting it, I'll reach out to property management companies that I work with and get their feedback. Because if I'm submitting a deal based on unrealistic projections that they can't hit, then I'm not doing anybody a service on that. What I'm doing is probably paying too much and setting ourselves up for failure because we have something that's not achievable. So I want to make sure the numbers I have are grounded in reality and that we have a good chance of hitting them. But then after we close, the next thing with the property management company to me is having some type of kickoff meeting. And with that kickoff meeting, what I want to do is I want to set clear goals for the property, because I want to make sure both sides are on the same page. Oftentimes, the greatest failures or the greatest mistakes in this business come from lack of communication or misunderstanding. So making sure that your property management company knows what you're trying to achieve for the property, when you're trying to achieve it by, and how much money you have to work with is going to be very, very important. And then having regular touch points to make sure that they're actually doing it. So especially if you're going in there and you're doing a heavy physical value add and you're going to be spending, let's say $10,000, $15,000 a unit, you don't want to go 3 months in and, you were planning that they were going to have 10 units done and they only have 2 done. Because if you were doing that and you didn't check, then shame on you as an asset manager because you didn't follow up and you didn't do your job. So regular communication, regular checkpoints, KPIs, those are all going to be very important things. At the most basic level, I just use spreadsheets to track things, but using the property management softwares, most of them have reports you can pull that are going to be very helpful. I routinely look at the rent rolls and the delinquency reports. Occupancy and collections to me are always the kind of the cornerstones of property management, then ultimately the basis for asset management. So I like to make sure at the very least that those two things are going in the right direction. And if I see problems in either one of those things, then I want to be having a conversation with the management company as soon as possible so we can kind of course correct and figure out where things went awry.
Yeah, Charles, and that makes sense, and I appreciate your perspectives there. I know that you're also a multifamily coach with Master Passive Income. What are maybe one or two different, mistakes or misconceptions that you see beginners make, and how do you help them avoid those pitfalls?
Great question. So there's a lot of mistakes I think we all make as beginners just because you don't know what you don't know sometimes. I'm gonna say two things that may sound contradictory, but they're both true in their own way.
This is a safe place to be.
Yeah. So the first is, can you do this if you aren't a multimillionaire and you don't have a lot of money? The answer is yes. Would I tell you that it's smart to get into a deal, especially a larger deal, if somebody on the team doesn't have sufficient cash reserves that they're willing to put up if needed? That I would tell you no, because that's a recipe for disaster. So one of the things people probably don't talk about enough in this business is you need to have cash reserves. And while there is a lot of truth, yes, you can do this without money. It doesn't mean everybody on the team can do it without money, because that's not going to work well. So you do need to have some money, even if it's not your own. So make sure to build those relationships. Another thing I would say, specifically on the underwriting side, because I know that's what many people tend to know me for. So the single biggest mistake that people make there is not underwriting the property taxes correctly when they're doing their underwriting. And a lot of people like to take what I would call the lazy approach and just kind of take either the broker's pro forma or kind of an estimated guess. What I would tell you is pick the phone up or send an email and actually contact the county tax assessor where the property is located. Understand how that process works, because that is a big difference. And like in some of these deals, and I'm sure the deals you guys look at probably even bigger, the deals I've looked at, there's times where I've seen the taxes double and triple and sometimes even quadruple. So in deals where that's a six-figure line item, that makes a big difference.
Yeah, it sure does. And I appreciate your sharing that perspective as well, Charles. Charles, this has been a remarkable conversation. I really appreciate, the value that you brought to our audience today. What maybe would be one or two different ways that our listening audience can connect with you to learn more about what you're up to?
Yes, absolutely. I'll give you two ways. First one is by email, and that you can reach me at C. Seaman, my last name. So first initial C, last name SEAMAN at masterpassiveincome.com. And the second is by cell phone. You can text me 347-306-3278.
Great, Charles. I really appreciate the value that you brought our listening audience today.
Great. Thanks so much for having me.
And listening audience, thank you again for jumping into another episode of The Freedom Point. Look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.